Thank you, Rachel, for the generous introduction. And good afternoon, ladies and gentlemen. And thank you for joining us on this panel on the global economy. We've got an excellent set of speakers, a lot of topics to go through. And the subject is, of course, the outlook for the global economy. But just before trying to think ahead about the outlook, it's useful to take stock of what has happened in the global economy in recent years. And one summary of that is basically 2018 and 2019 were dominated by the trade war between the US and China. 2020 was the year of the pandemic. 2021 was the year of the recovery from the pandemic. 2022 was the year of inflation. 2023 is the year of probably peak interest rates. So my question to the panelists is, what is going to define 2024? And maybe I'll start with Anne.
Thank you so much, Ziad. Well, I often say these days, I'd like to stop living in unprecedented times, but we continue to live in time of volatility. And when this year started out, I used the word, this is the year of idiosyncratic risk, and I believe that that will continue into 2024. We actually are predicting a recession in the US, and as the U.S. begins to slow down, so will the rest of the world, in our opinion. Risk is definitely increasing. The tail risk is getting larger. We now have geopolitical risk that we hadn't really seen. And the backdrop is based on the fact that we are now in a very different global environment. We've moved from the quantitative easing era into the quantitative tightening era. We are now in a world of reflation, deglobalization, a multipolar world, and all of this is driving market activity. We've ended the 40-year bull market in bonds in the US, and so this really drives us into a very different investing paradigm as we go forward. So 2024, I think, will be another year like 2023, except it will be slower in our view with regard to global GDP.
Thanks, Anne. So 2023 with some slowdown, recession and risk. How do you see that, Gary?
I think the one thing that I would perhaps give as a takeaway is we have to get back to normal. And a lot of people have characterized normal as the last 20 years. So as I've been in this industry for over 40 years, I'm going to say it's 40 years. And the thing that we've got to get into our thinking is that inflation hangs around, that we have to have recessions. Because I remember, because I used to work with Bruce Kasman at JP Morgan, and he always schooled me on economics, and he kept saying, the good thing about the United States is as a good recession, it clears out all the nonsense, it clears out the misallocation of capital, and then we move on. And we have a flexible economy to deal with that. Unfortunately, the last 20 years have been about cancelling cycles, sometimes for good reason. But we've got to stop cancelling cycles. And I think in 2024, we're going to need to do that because we can't bail ourselves out of it through fiscal stimulus. And we can't bail ourselves out of it through lower interest rates because we'll have that inflation hanging around.
So you also see a recession next year in the US?
We need it.
We need it. James?
Yeah, I take issue a little bit. I mean, I do think there'll be a slowdown or possibly a recession in the US, but I think inflation will also come down, and therefore I think that interest rates will be cut quite sharply in the second half of next year by the Fed, probably 150 basis points. It's our working assumption. I don't really believe that inflation is going to persist as much as people are making out at the moment. And if you look at the US consumer, currently in very strong shape, but you've already got signs of distress in the sort of lower segments. Lower income households are beginning to really struggle. And I think the Fed will act, despite what it says at the moment. This time next year, I think we'll be into a lower rate mode.
Okay, so that's a slightly better picture with lower rates and inflation coming down. And let me stay with you, James, because a big thing that has happened this month, in fact, is the war that's currently taking place in Gaza. How do you see that affecting the global economy? And if it does, how so?
Well, I mean, first of all, the human cost is just indescribably bad. I guess for the region, it's bad because, okay, you'll get a bump in oil prices as we've had, but I think that's really going to be more than offset by the likely decline in FDI, foreign direct investment inflows. Dubai might be slightly different because it has a sort of safe haven allure. But I think for the bigger economies like Saudi, Egypt, it's going to be a problem. And then you'll also have a hit to tourism revenues, which have been very buoyant, actually, at least in Saudi. So I'm really disappointed that that's going to be the case because tourism was just getting going. Of course, there's a large element there of religious tourists who will come regardless. But overall, it just sours the picture. As for the global economy, I can't see too much impact. I mean, geostrategically, I imagine that the US will probably have to think about the Middle East in a way that it wasn't doing during the Obama administration. It's one thing to have Iran, GCC tensions. It's another thing when Israel gets attacked, which is, I'm thinking here about the US calculation. So I think they're going to be looking at East Asia and the Middle East probably in terms of priorities, probably pretty much equally. I don't know if that has an awful lot of implications for the global economy as such, other than it does kind of lend this, sort of emphasize this sort of fracturing that we've been talking about between different blocs.
Gary, we've run some numbers on the impact of the war at Bloomberg, and basically our analysis says the conflict remains confined to Gaza, huge human cost, but the impact on the global economy is probably limited. If it spreads out, and especially if it ends up being a direct conflict between Iran and Israel, that could take the global economy into recession. Now, for you as a CIO, how do you manage investments in this environment, and how do you see the war?
Yeah, I think by being a human being rather than just a CIO, you don't want to contemplate the worst outcome here. You don't want to see this conflict and tragic conflict broaden out. I mean, I kind of almost romantically thinking back to January, February this year when I was in Tel Aviv. I was traveling around. For me, it was the Holy Lands. And, the peak of the positivity was a matter of weeks ago. At G20, this agreement on this corridor that was going to go up from India straight through the Middle East, through Israel, and up into Greece and beyond. What a fantastic concept that was. 70% of the infrastructure was already there. I think there was 20 flights between here and Tel Aviv, which when I came to the Gulf in 2009 is such a dramatic contrast. I'm just hoping that we can just grab this situation in coming weeks and suppress the worst elements of it and get back to that vision. Because the vision's on the table, the plan's on the table, and it's something that's going to create wealth for the whole region and not just for a few.
Sure. And obviously we cannot control the geopolitics, but we can analyze the economics here. Now, James mentioned something very interesting, which is if you look at the impact of the conflict in Gaza on the Gulf, and you're based here in Dubai, you have on the one hand, oil prices are rising, and that is positive for the GCC. But on the other hand, you have the geopolitical risks are rising as well, and that tends to be negative in terms of FDI and tourism, etc. How do you see that? What do you see the net effect? Is it positive or negative on Dubai and on the GCC?
Yeah, I think my greatest worry is the weaponization of inflation. And clearly, if someone was trying to upset the world at the moment, it would be to give another edge to that inflation with a further push up in oil prices. So what worries me, agreeing that there's consequences for UAE, there's consequences for Saudi that people just get less enthusiastic about investing in the Saudi or the UAE because of the backdrop. You can see that greater risk. But I do think that the weaponization of oil, if it creates an inflation problem, it comes at exactly the wrong time, because I've got sympathy for what James was saying about inflation could come back and we could see lower interest rates. But in the current environment, the risks are, I have to say, to the upside, given an oil price that on some circumstances, you could envisage being up there at the $150 level.
And how is the conflict viewed from the US? Is it going to impact the US economy, or is the US too distant from what's happening here in this region?
So I think the risk for the US economy is more to the downside. As I mentioned, we're expecting a recession, and our base case is that the recession in the US would be fairly mild. And to Gary's point, a normal cleansing process that we haven't seen in business cycles for quite some time. But the Fed is very concerned about a repeat of the 1970s. And I think this is one of the reasons that they want to remain on hold at higher level for longer, is that they are concerned about the volatility of inflation and the risk that inflation comes back. This is made even more challenging by this recent conflict and the concern that the conflict could ultimately expand and would disrupt oil flow. And that $150 a barrel number is one that we have modeled as a potential risk if the Strait of Hormuz were to be closed. And the availability of more oil coming online fast enough would not be timely enough for that to be offset in the short run, causing more disruption and, frankly, more risk of a worsening recession globally and an oil price shock. So I think the U.S. policy and the Fed policy is reacting to this risk at this point in time, and there isn't a lot of clarity. I'll go back to my word idiosyncratic risk as a placeholder of where we find ourselves today, made worse by geopolitical risk.
So, Anne, staying with your themes of idiosyncratic risk, slowdown, big driver of global growth through the last 20 years has been China. China is slowing down. Are you worried that a bust in the China property sector, for example, could drag the global economy into recession next year?
So the China property problem is very large. And I don't think we really can kind of get our heads wrapped around the scale of this relative, say, to the U.S. Real estate world. In the U.S., the real estate market is total around $25 trillion U.S. dollar equivalent. It's close to 2.5 times that in China. And as a result of the expanding property problem, investment in China will be limited. And the policymakers in China are going to have a hard time trying to manage their way out of this. It actually makes the U.S. subprime crisis much smaller in comparison. And so as a result, I think it does have a global effect. It's not one that plays out in the short run. Even in the U.S., as we slow down, the U.S. office property, commercial real estate problem is also evolving. These are slower moving cycles. And as a result, I think that these are slower moving effects, which will potentially expand that recessionary timeline that I'm talking about beyond, say, 2 quarters, which would be the standard definition of recession.
Gary, how do you view China? Are you worried about a significant and long-term slowdown in China, which could drag global growth down?
Yeah, if I take the sentiment as a reading from the equity market, you'd say it's fully discounted because we're down to single-digit P multiples and high dividend yields. I take Anne's point that there's a massive problem there, but I just feel that unlike the West, China can internalize this. That it's not as if they're asking foreigners to put capital in order to save their real estate sector. And quite frankly, they could just take a leaf out of the book of the Fed and print some money to potentially paper over some of the problems they've got. So it's an economy that on most forecasts is still growing. It's an economy that can, I think, internalize some of its problems. It might go missing in terms of its contribution to global growth because we've been too overly reliant on it. But I think it just about muddles through. And it clearly hasn't got the excesses that we're seeing in other parts, the extreme excesses in terms of both the fiscal side and in terms of the consumer side that we see elsewhere. So there are levers they can pull in order to push growth, but they've got to rebuild confidence. One last thought though, my concern is that China's gone missing in terms of funding the rest of the world. I'm involved with some green initiatives where China would subsidize and provide cheap funding. That funding at the moment is not there.
Okay. James, when it comes to China long term, China is not just the driver of global growth, it's the biggest importer of oil around the world. And one of the reasons why we have a boom in this region, whether here in Dubai or where you live in Saudi, is oil prices are high. Are you worried about the long-term sort of price of oil with the slowdown in China, with the transition away from fossil fuels?
Not especially in the near term or medium term. It's interesting that the Chinese logistics sector is now the main driver of oil demand. It counts for around 70%, whereas, say, 10 years ago, it was the property sector, construction. So what's happened is there's been a shift away, and as such, the transport and logistics sector in China, which is very kind of active and dynamic and robust, is drawing in quite a lot of oil. So although there's been this kind of disappointing macroeconomic drip feed of kind of bad news, if you look at oil imports, they've actually held up really well. And I suspect that will continue, that structural shift, as logistics is expanded. So I'm not that worried about China from that point of view. But I am, as Gary said, I mean, muddling through is not something it's not a phrase you expect to have linked to China. But there are, I think, good reasons to expect a sort of slightly limp forecast going forward, because really the demographics are troubling and urbanization is slowing down very quickly. Typically an economy at this stage of development would start to liberalize in order to gee up growth a bit. But in fact, that's going the other way. So I'm worried because China has built all the roads and bridges and railways it really needs, given the declining population. And so it needs to really jig up the consumer and liberalize all sorts of services, but it doesn't seem at the moment willing to do that.
Sure. And you said you're not worried about oil prices in the near term. Of course, they're quite high. They're about $90 per barrel now. Do you think would be a change in Saudi oil policy? Would we have a reduction in the supply curves that Saudi Arabia has implemented since July this year?
Yeah, I do. But I think it'll be delayed. I think the Saudis will, and I don't have any inside knowledge on this at all, but I think the Saudis will begin to reverse their production cut in the second half of next year, gradually. And that will be in line with Fed cuts to interest rates, which will give a supportive backdrop to risk assets, including oil. So that's my best guess.
So more liquidity on interest rates and on oil. That's good. Anne, we spoke about the US, we spoke about China, we spoke about the Middle East. What are the bright spots in the world today? Where do you see are the optimistic sort of pockets of growth in the world today?
So there is optimism, and if I take the long view, I see technology, artificial intelligence, increasing productivity. I'm very positive for the long run, but we have to get through this stage of reallocating capital in a more efficient way, and there are mechanisms to do that: private credit, infrastructure, and selective real estate investing. Hard asset investing, as well as high quality fixed income, continue to be places that we can invest in the shorter run while we work our way through this change and this reallocation of capital.
Okay, so we're out of time, but I'll have just one round of quick-fire question, yes or no. Will oil prices hit $120 per barrel before November 2024?
I hope not, but probably yes.
Anne?
I would have to say the same thing. I hope not, but it's very likely.
No.
No, okay. Well, we've got US elections also next year, so let's see if what's going to happen with oil at 120, if it does happen. Thank you so much. We've gone through a lot. We're out of time. Thank you very much for your input and your insights. And please join me in thanking our panelists for an excellent set of ideas.